Hello, I am Harry White, and today I will be going over our Session 3 assignment. So, for the Session 3 assignment, we were assigned with a situation. We're in an imaginary scenario where we inherited $75,000 and we want to invest in Microsoft, or considering it. That is currently at $380 per share. This is the information we are given. They pay an annual dividend of $3 a share. The dividends have grown at 10% annually for the last 5 years. Analysts expect 4% growing forward. S&P 500 return 10% annually on average. Treasury bonds yield 4.5%, and another option is putting money in a savings account at a 4% annual interest. The questions we're going to explore are right here, and we will go over them later. So, using the driver framework, we are for define and discover what makes a stock valuable and what are investors really buying. So a stock value is based on the claim of their future earnings, what they are going to do in the future. If they have great earnings and they do great in the future, the stock will go up, they'll be valued more. And the opposite for if they do bad. Investors are buying a part of the company when investing, meaning that the future of their investment and their money that they put in relies on the future of the company's success. So one big part is that we have to calculate the intrinsic value of the stock using DDM. This is the formula right here, D1, which is next year's expected dividends divided by the required rate of return minus the expected rate of growth. All the variables are given above, and these are what they are. So this will be used to calculate and answer this question. So map out the expected cash flows. I went ahead and calculated the intrinsic value to find next year's expected dividends. We put in the current dividends multiplied by 1 plus the expected rate of growth, which is 4%. Putting this in here, the intrinsic value calculated by me is $52. That is what the stock is currently worth right now. So it shows that it's a lot lower than the 380 it's currently valued at, but this can be explained. DDM is often unreliable with modern technology companies such as Microsoft due to their low dividend payments. I'll go over that more in depth later. For implementation, my data is in Colab and Gemini, so I plug and placed this. I said use KISS, keep it simple, stupid, to build a Python code based off of the following scenario, which is the scenario that we had earlier. It created the code for me and it summarized the analysis, but this isn't important right now because we use the Colab. So this is the code that it gave me. I ran it, and this is everything it calculated. It answered all the questions. The intrinsic value calculation, DDM, the next dividend, which I got before, $3.12. Required return is 10%. Perpetual growth is 4%, and this is what you get by plugging it in. So sensitivity to growth assumptions. If we come back over here, the stock is valued at 380, but the intrinsic value is 52. Large difference, but the DDM is very sensitive because a 1% change in growth can boost a stock up $13, showing you how sensitive and volatile it is. And for the rest of the answers, it said extremely sensitive. These were the implied expected return and the required return. DDM suggests the stock is very overvalued because it's valued at $380, but the intrinsic value is $52. And Colab recommends that we can only buy 197 shares of the current stock with our $75,000. And the recommendation, what we calculated, the expected return of 4.82% is below our required return of 10%. Colab recommends to invest it in something else, bringing us over back here. So basically with my answers combined with the data from Colab, answering the questions above, the stock is very sensitive, DDM is very sensitive. Due to a 1% change leads to a $13 growth, which is a big percent of our 52 calculated dollars. Next question is, if you buy at $380, what return can you expect? You spend all your $75,000 at $380 a stock, you get just under 200 shares. So that is what you will get. And is the $380 a good buying price? No, it is not, because using DDM, the stock is valued at $52, so it's less than 6 times of what the stock is valued at. It is very overvalued. The data suggests that the $75,000 should be invested as something else other than Microsoft due to the fact that it's very overvalued. I agree with this completely, because while DDM is usually not as effective, and I'll get into that later, it is a huge differential, and there are a lot smarter things you can invest the money into, long-term growth, because I also see Microsoft as more of a long-term growth company rather than a one-year return, 20%, 30% kind of stock. For Evolve, how would different growth assumptions change your valuation? If the growth assumption was higher than it currently is, the stock would make more money. But in order to make it a smart investment, it would have to surpass the 10% required return, which is a big jump because the growth assumption is 4%. So it is overvalued, and I would value Microsoft as a better stock if the growth assumption was higher, because it could make more money, but it isn't so, and it's under the 10% required return, so I do not see it as a valuable stock. For my reflection, it asks, what does the gap between your valuation and market price tell you? It tells me that according to DDM, the dividend discount model, Microsoft is an overvalued stock and is a not smart purchase. It tells us that Microsoft is very overvalued with the eyes of DDM, and no one should buy it because it's extremely undervalued. But DDM is often unreliable with modern technology companies such as Microsoft due to the low dividend payments. It's not as consistent. It doesn't speak to the stock as well, because Microsoft is a technology company and it evolves every year, so they can't account for that. They're just accounting for what it is right now, the intrinsic value. AI is a big part in this, and I'll go into that. My recommendation is investing in another stock or bonds due to the low intrinsic value compared to the stock value of Microsoft. This, however, does not mean that Microsoft is a bad investment. It means that it is overvalued by DDM, but companies like Microsoft often exceed the expectations of DDM. AI is a large factor in the stock being worth more than calculated, because investing in Microsoft means you're also investing in AI and its development and its continued success. It's at an all-time high right now, so if you do invest in Microsoft, your big hope is that AI continues to be great and it helps you out. But overall, I learned a lot from this assignment. I learned how DDM can help you quantify the intrinsic value of a stock and how that can help you invest your money into smart endeavors. I would not personally invest in Microsoft. I'm not saying that it is a bad investment because DDM doesn't speak to it, but in my personal opinion, it is extremely overvalued. Even if the intrinsic value, or even if the value that DDM calculated is is less than it actually should be, I don't think it's worth the $380 that it's currently worth. I think it's worth less. Thank you very much.